Welcome to ETF Explained, a series on the Get Started Investing podcast. Each episode, we explain one ETF to better understand it and help you analyse any ETF. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Today's episode, we're talking about the JPMorgan Global Equity Premium Income Complex ETF. The ASX ticker is JEGA or JEGA. But luckily, we're not looking at it alone.
No.
We've got the portfolio manager for that strategy. He's the CIO of US Core Strategies at JPMorgan Asset Management. Hamilton Reiner, thanks for joining us again.
Thanks for having me, guys. Appreciate it.
So, Hamilton, let's kick off with understanding and unpacking the name because there's always plenty of information that we can get from it. So we've got the product issuer is JPMorgan Asset Management. The investment asset is global equities. The focus is income, which we'll unpack in a little bit. And the investment style is complex ETF. So we want to start there. The last two funds that we've discussed, JEPI and JPEC, were active ETFs. This is a complex ETF. What's the difference?
Well, if you thought I wanted to put the word complex in there, you got another thing coming. But the regulators believe that because the strategy uses structured products or options, you now have to put the word complex into the ETF. But it's not really complex. It just uses options.
Nice. So it is an active ETF, very similar to the two that we've previously spoken about. And given regulation, I'm sure the names, and this is across industry, will all catch up over a period of time. And we'll start seeing that word complex in many more ETFs
I think,
over the next little while.
I think we should say for Australian investors, expect to see complex a lot more for any ETF that involves structured products like options. So if it's the first time you're hearing it, chances are it won't be the last.
Yes.
Yeah.
So, Hamilton, let's start with the purpose. What is the purpose of this ETF?
So as it's in its name, income. Income is the outcome. And we're looking to give you income around a global portfolio of actively managed securities.
Nice.
So for people who have listened to our last two episodes on JEPI and JPEC, it's a similar strategy. But for people who haven't, can you talk about how you're sort of balancing long-term capital growth and income and then getting the level of income that you want from equities?
Sure. So it all starts with security selection. So we're going to take a look at the MSCI World Global Index and its holdings and the names that are in that index. And then based upon our fundamental analysts, people that actually live, breathe, and eat stocks, try to find those stocks that we find most attractive, those stocks we think they're going to appreciate the most. But we're looking for those stocks that have less risk, less volatility, kind of stocks that are not going to move a heck of a lot down or as much down when the market sells off. So it has a very much a defensive-like quality. It's a very conservative type of group of stocks. And then you combine that by selling options for income. That underlying long portfolio, because it's global, is going to have a fair amount of dividends. We expect that long portfolio to have about 2.5% to 3% of dividends. And then the option overlay is going to have about 4.5% to 6.5% of income from selling options. So it is a global portfolio that's going to have a fair amount of dividends, plus some options premium, and you package that all together, you end up with a global equity premium income product.
Nice.
Now, we use the product issuer website as the source of truth for the information and...
You could trust me.
Look, I trust you. On the website, you've got income is the goal, not the target. What is the difference between goal and target, and how should we understand that?
And this is a very big distinction, so thank you very much for picking that up. When you target something, you will do what is ever necessary to hit that target, whether it's rational or irrational, because it is your target. And when we think about the word goal, we're going to have a very disciplined approach to investing, picking our stocks. We're going to have a very disciplined approach to our options overlay. So we're never going to go out and just buy a stock because it has a high dividend unless we like the stock. So that's one way of thinking about it. We're not going to sell an unattractive option just to hit a target. We're only going to sell the options that make sense with our investment process in a very disciplined manner. So goal is, think about it this way, goal is like best efforts. whereas target is you got to hit it. And so we expect our goal to be 7 to 9% income paid out monthly through a cycle.
Nice.
Makes sense.
And then for investors, how should they be thinking about this ETF and how it fits into their portfolios?
So the reason we brought this product to market is after our first two products that we spent some time on already together, guys, they said, oh, this guy's very U.S. centric. There's other parts of the world besides the U.S. So we came to market with this global equity premium income because there are many, many investors that wanted to have a global footprint. So the first starting point is it is an equity with income, and the underlying portfolio is going to be very much global in nature. It's going to be like most global products. It's going to be about 70% U.S. and 30% ex-U.S., like most global indices. And as far as putting into a portfolio, think about it as an income-oriented strategy. So it could maybe replace other income-oriented stuff in your portfolio. And I guess stuff is an official investing term. It could replace other income stuff in your portfolio. Or it could actually be a conservative equity. Because given tumultuous times and a fair amount of uncertainty, why not put a conservative group of global stocks into your portfolio that's designed to give you 7 to 9% distributable income through a cycle and have a little less volatility or conservativeness relative to an overall global index.
And so what benchmark are you using?
So this strategy uses the MSCI World Index as its benchmark, as a reference point. But this strategy is designed to have approximately 45% less volatility in beta than that index. So you should not expect this strategy to outperform the index through a cycle because it has so much less volatility in beta. But what you should expect is for it to actually do, over time, better than that 55% of the index, because that's kind of the risk profile it has. And you should expect us to have that 7 to 9% distributable income through a cycle paid out monthly.
Love the paid out monthly. So Hamilton, as we have in previous episodes, we always like to look at fees, and you are nothing if not consistent, because the fees for this ETF, similar to the last two that we've spoken about, 0.4% or 40 basis points, which is the equivalent of 40 cents per $100 invested. I said it the last two times, I'll say it again. We love it that this active ETF is at the cheaper end of the range.
We don't want to be cheap. We want to be effectively priced.
Okay, nice, nice.
And the other thing I would just highlight, which we didn't really mention in the previous two, but it's important for a global product, all three of these ETFs have both a unhedged and a hedged product, and they're all priced at 40 basis points.
Oh, okay.
Nice.
Oh, that's good to call out. Yeah. So let's now turn to performance and distributions. Now, this only listed on the 1st of August in Australia, so it's relatively new, and it's trading in Europe, but it hasn't been trading for that long in Europe either. So I guess, how are you thinking about performance? Have you back tested the strategy, or do you have any indication of how it would have gone?
We do, because what's very interesting about this strategy is we took an existing long portfolio, the stocks that we select, and that long portfolio we've been managing out of Europe for pensions, endowments, foundations, retirements since 2012. So the backdrop of this is we just didn't come up with a brand new way of picking stocks and say, oh, stick it in an ETF. It's a long, time-tested process and product that we're managing for institutions. And if you think about it, it's very much the global cousin to JEPI, very similar in philosophy. Instead of buying a conservative group of higher quality US names, we're buying a conservative group of high quality global names. Selling out of the money options on the global indices, as opposed to just selling options on the US indices. So it really has that very similar flavor, and it's almost like a sibling, fraternal twin, relative to our longer-standing U.S. product.
And what's been the distribution history of the unlisted product?
The unlisted product is very much just the long portfolio.
Yeah.
It's not the one with the options overlay. Those are the sprinkles that we're putting onto the ETF.
Nice, okay.
The unlisted product, the distribution's been between 2.5% to 3%.
Yeah.
Which is how we reference it in this, because we expect it to be very consistent with how we've been managing that strategy since 2012.
Yeah, and that's what you said earlier in this episode, that the dividend yield is sort of 2 to 3%, and then the income from the options is sort of 4 to 6%. I think you said.
Yep.
So combine those two, and it's pretty interesting. So let's talk about the top holdings, and as we always say, if people, all of the information we're talking about, you can get on the ETF issuer's website. So if you want to go under the hood yourself, you can see what we are saying. What we noticed when we looked at the MSCI All World Index and the top of that index and compared it to the top holdings in this fund is they're quite different. So the top of the MSCI All World Index is your classics, your Apples and your Microsofts. Whereas here, some of the bigger players or some of the bigger holdings in your funds, T-Mobile, Dutch Telecom, United Health, Roper Technologies, Motorola Solutions. So 2 questions. Why are they different? And then secondly, 3 telecoms in the top 5. Is that a particular interest?
Telephones are always interesting. But when we think about the MSCI world, and as well as what we're trying to accomplish on the long portfolio here, the long portfolio in JEGA, we're seeking to find that combination of higher quality names, those stocks that have predictable earnings and have less volatility and risk than other stocks in the index. And when you look at the MSCI world, there are lots of great companies in there. But a lot of those companies have a lot of variability as to what they're capable of earning. And if you think about it, telecom companies, it's pretty predictable. We all have phones. They have a pretty good idea as to we're going to keep those phones, use those phones, pay our bills. I think many people actually pay their phone bills before they actually pay a lot of their other bills. Can't live without your phone. And so those stocks tend to have some of the most predictable earnings. So what we're seeking to do in the portfolio here is buy stocks we like that are attractively priced, stocks that are more steady Eddie stocks, and stocks that probably hang in a little bit better because they have this very stable earnings focus, going forward. There's nothing wrong with those names that you mentioned in the MSCI world. They're just a little bit spicier in many cases than the type of names we're looking to own here.
And we should be clear, Microsoft is in the top 10 holdings still. It's number 7 on the list. So it's not like it's not there. I'm not sure if Apple's there, but I'd hazard a guess it probably sneaks in there
Be a
at
little
some
farther
point.
down.
Yeah. So it's just, I guess that's active management for you.
It is active management. Once again, that long portfolio is going to have about 30 to 40% less volatility and risk than the MSCI world. So when we think about that underlying long portfolio, we're actually investing for not what just could go right, but perhaps what could go wrong. And when you build a portfolio that has less volatility and less risk, if and when the market goes down, and we're not rooting for that, if and when the market goes down, these type of stocks hang in better. And the most important thing we all could do is find a way to stay invested. And if you find a way to lose a little bit less when the market goes down, you probably stay invested.
Well, Hamilton, to close out, we've covered 3 income-focused active ETFs over the last few weeks. How should we think about tying them all together in a portfolio? Is there a world where you would have all 3? And I guess as well, what is your favourite?
I would hazard a guess that Hamilton has all 3.
Absolutely. And as all of their names state, the word equity is in all of them. With JEPI, it's equity premium income. With JEPIC, it's 100Q equity. With JEGA, it's global equity. So for me, I believe it's if you were only to choose one, is what type of stocks do you want to own? So if you want to be international and global, then JEGA is your ticket. If you want to own something that's a little growthier and techier, then JEPIC is your ticker. If it's something that's higher quality, more defensive, then it's JEPI. But what's really nice is the holdings are all very different. So you can actually own a little bit of each one, and they play nicely together in the sandbox. Because the holdings in JEPI are going to be very different than the holdings in JEPIC. And as you just highlighted, the holdings in JEGA are going to be very different because they're global, and in many cases, you're going to have different types of names. So you just highlighted Microsoft being number 7. Well, in JEPIC, it's top 5. And in JEPI, it's going to be top 10, but each one is going to have a different weighting. So you're not creating duplicative holdings by putting these things together. So I'm not going to tell you one's my favorite.
Damn it.
Because it really starts with what type of stocks do you want to own.
Yeah.
And if you think about it that way, it's one of the best ways of investing.
Yeah.
It always has to start with what do you want to own. The income's going to be quite healthy in all three.
Yeah.
So it's not just about the income. And yes, the income is great. It's epic. Yes, it's going to be paid monthly. But that should not be the driving feature. The driving feature is what kind of stocks do you want to own? And then you get the income as a kicker.
Yeah.
Well, Hamilton, it's been an absolute pleasure having you all the way from the States here to unpack these 3 ETFs with us. We certainly got a lot out of it, and you've helped our audience understand how to analyze these ETFs a lot better. So thank you very much.
Thanks for having me, guys. Appreciate it.
Thanks, Hamilton.